Welcome to the Byte-Size Brief. Today, we are putting Onfolio Holdings, ONFO, that's ONFO, completely under the microscope. Let's get into it.
We really have to. Just look at the immediate explosive news from Thursday, April 16th, 2026.
Oh, the trading action was just insane.
Right. A previously obscure microcap stock skyrockets 124.89% in a single day.
Yeah, and with an astonishing 275 million shares changing hands.
Exactly. Watching it violently fluctuate between $1.05 and $2.48 in just a matter of hours was wild.
When you see volume and volatility like that, you know a fundamental narrative has shifted.
Definitely.
And we need to dissect that reality for you, the listener.
Yeah.
Because, a surge like that does not happen in a vacuum.
No, it really doesn't.
We have to separate the actual fundamentals from the hype. So our mission today is to dig into their newly announced $100 million equity facility.
A massive number for a company that size.
Right. We're also testing the reality of their 2025 earnings results and challenging this aggressive dual pivot they are making into artificial intelligence and cryptocurrency.
Which is quite the combination.
It is. We need to know, is this a revolutionary new holding company business model or just a highly risky speculative play layered in tech buzzwords?
Well, to figure out why a financing announcement sent the stock soaring, we first have to establish how Onfolio Holdings, ONFO, actually generates cash in the first place.
Right, the core business.
Exactly. At its foundation, they are a serial acquirer of small digital businesses.
So they buy up other companies.
Yeah, they buy B2B agencies, SEO services, e-commerce sites. And the strategy is based on what the CEO, Dominic Wells, calls the math of serial acquisition.
Okay, let's scrutinize this math.
Hmm?
Because looking at their history, the multiples they pay seem incredibly low.
They are.
Large institutional buyers or private equity firms usually pay 10 to 15 times annual cash flow for a mature business, right?
Generally, yes.
Which means they need a decade or more of perfect execution just to break even on the initial purchase.
Right. But Onfolio Holdings, ONFO, targets ignored nano-cap digital businesses.
They're really small guys.
Exactly. Based on their track record of their 7 recent acquisitions, they are buying at a blended multiple of about 3.3 times annual cash flow.
Wait, 3.3 times?
Yeah. For example, they acquired a branding and web agency called Eastern Standard for $2.16 million.
Okay.
And that single agency brings in $630,000 in annual cash flow.
Wow.
They also bought a site called Proofread Anywhere for $4.5 million, which pulls in $1.2 million annually.
So basically, it's kind of like buying a rental property in cash where the rent pays off the entire house in just 3 years, and everything after that is pure profit.
That captures the mechanism perfectly.
Hold on. How does that actually affect Onfolio Holdings, ONFO's stock price, for regular investors like me?
Well, by year 4, your original capital is entirely returned. And you take that cash, buy a second business, and the first one continues to generate free cash flow indefinitely. But I know you're probably wondering.
Yeah, if the entry price is so cheap and the returns are that fast, why isn't private equity eating their lunch? Are they just buying digital junk?
It's a completely fair skepticism, but the reason these businesses are so structurally cheap is the market itself.
How so?
It is highly fragmented, and there is zero institutional analyst coverage. A $2 million website is simply too small for a massive investment bank to care about.
Oh, they're flying under the radar.
Precisely. Furthermore, institutional investors view these tiny digital assets as inherently unstable. But honestly, the biggest factor keeping the stock price suppressed is actually GAAP accounting rules.
Ugh, the joy of generally accepted accounting principles.
I know it's dry, but it's crucial here.
But wait, isn't GAAP designed specifically to stop companies from hiding bad investments? If they're losing money on paper, shouldn't we trust the paper?
Normally, yes. GAAP is designed for transparency, but it creates massive distortions for serial acquirers.
Why?
Because when you buy a business, you have to amortize the intangible assets over time.
Amortize intangibles. Okay, we need an analogy for the listener here.
Sure.
Let's say I buy a famous local restaurant. The physical building and the ovens are tangible assets.
Right.
But I am really paying a premium for the secret sauce recipe and the loyal customer base.
Exactly.
So amortization is like the accounting rules, forcing me to pretend that the secret recipe loses 10% of its value every single year, and I have to write that off as an expense.
That is brilliant. Yes, exactly that.
So it's just a paper loss.
Right. Even if the restaurant's register is full of actual cash every single night, your accountant is telling the IRS that the restaurant is losing money.
Because the value of that secret recipe is technically depreciating on paper?
Yes. So for Onfolio Holdings, ONFO, they could be generating fantastic real-world cash flow from a business like Eastern Standard.
But on paper, their GAAP earnings make it look like they are hemorrhaging money.
Exactly. And traditional algorithmic stock screeners automatically filter them out as a failing microcap.
Okay, so if they really are buying these cash-flowing properties at a 3x discount and the losses are just accounting fiction, that should be glaringly obvious in their bank accounts right now.
You would hope so.
Okay, so compared to last quarter, what actually moved the needle here?
Well, the fourth quarter and full year 2025 data paints a very complex picture. Let's look at the operational cash first.
Let's hear the good news.
There are huge improvements. They grew top-line revenue by an impressive 36% year over year.
Wow, 36%. Up to what?
Up to $10.73 million. They also managed to expand their gross margins to 60%.
That's solid.
And crucially, they achieved their first positive EBITDA year ever, coming in at $151,000.
That is huge. I mean, we hear EBITDA thrown around constantly. Earnings before interest, taxes, depreciation, and amortization. Basically, it strips away all those paper losses, like our restaurant's secret recipe and the tax complexities, to show us if the core operations are actually making cash.
Exactly.
So hitting a positive $151,000 EBITDA, up from what, a negative $588,000 the year prior?
Correct.
That's a vital milestone.
It proves the underlying portfolio functions. The acquired businesses themselves generated a portfolio operating profit of $1.8 million.
Okay, the engines are running hot.
They are. They also grew their actual cash on hand from $477,000 to $2.17 million.
That sounds great, but I am looking at the bottom line of this report right now.
Ah, the net loss.
Yeah, despite that $1.8 million operating profit from the portfolio, Onfolio Holdings, ONFO, still posted a full-year net loss of $2.54 million.
Yes, they did.
How do you make an operating profit of nearly $2 million but still end up losing $2.5 million overall? Walk me through the bleeding.
The bleeding comes from two distinct places.
Okay.
First, parent company overhead. Their total operating expenses ballooned from $7.1 million to $9.3 million.
Why the jump?
Largely because they absorbed a full year of carrying the operational costs of Eastern Standard.
Got it. And the second place?
The real damage comes from $2.37 million in non-cash expenses. And this isn't just the harmless amortization we talked about earlier.
Oh, what is it then?
They had to take real asset impairments.
Ouch.
Yeah. For example, they wrote off $217,000 for a property called allthingsdogs.com.
Uh-huh. So my earlier question about them buying digital junk wasn't totally off base.
Not entirely, no.
If you have to take an asset impairment, it means you overpaid for a digital asset that is no longer performing, right?
Yes.
And you were forced to wipe that value off your balance sheet entirely.
That is the execution risk of being a serial acquirer laid bare. You buy 10 businesses and, well, maybe 2 of them fail.
That makes sense.
Furthermore, in Q4 specifically, they saw their B2C, that's business-to-consumer revenue, compress.
Why did that drop?
Management had to deliberately pull back on advertising spend for the Proofread Anywhere business.
Because ads were getting too expensive.
Exactly. The return on ad spend was dropping. It was a disciplined move to protect cash, but it severely hurt top-line growth.
Okay, so they're proving the portfolio can generate cash, but the parent company is expensive to run.
Right.
And those bad acquisitions act like lead weights on the financials.
Very much so.
This persistent net loss and tight cash position is the exact context we need for the April 16th bombshell.
It is, because on April 16th, Onfolio Holdings, ONFO, announced a massive $100 million equity facility agreement with an institutional investor.
That is a staggering number.
Especially since, prior to this, they had paused all acquisitions for 18 straight months.
Right, they had to focus on optimizing existing businesses and fixing their balance sheet.
Exactly. And this new discretionary capital is meant to fund working capital, resume their core acquisition strategy, and grow a digital asset reserve.
Man, the broader stock market just goes crazy over capital raises. I mean, retail traders love a big shiny number like 100 million.
They really do. The hype is real.
Right, but what does all that actually mean for Onfolio Holdings, ONFO investors?
It's extremely complicated.
Because a company with a pre-surge market cap of under $4 million suddenly securing a $100 million facility, Sounds completely impossible without triggering catastrophic stock dilution.
And that is the critical risk check the market is ignoring in the frenzy right now.
Tell me more.
Retail traders are celebrating the $100 million headline, but buried in the SEC filings is a much darker reality.
Uh-oh.
Onfolio Holdings, ONFO, is currently in default on $6 million of their senior secured convertible notes.
Default. You don't just brush past a debt default.
No, you don't.
That means they formally breached the covenants of their loan agreement.
Yes, they did. And they are actively negotiating default waivers with the note holders right now.
Which means the note holders have all the leverage.
Exactly. And here is where the mechanics of dilution become genuinely terrifying for regular shareholders.
How bad could it get?
To secure those waivers, they likely have to offer the note holders a steeper discount to convert that debt into shares.
Okay, break that down for us.
Currently, the notes might convert at 97% of the volume-weighted average price, or VWAP.
Right.
But these default negotiations could push that discount down to 85% of VWAP.
Oh, man. We need to explain this VWAP conversion mechanism clearly because it is infamous on Wall Street.
It really is.
It's often called the convertible debt death spiral.
A very fitting name.
Let's say the stock is trading at exactly $1. If the lender gets to convert their debt into shares at an 85% discount, they get shares for 85 cents, right?
Correct.
So they are heavily incentivized to immediately dump those shares on the open market for a guaranteed risk-free profit of 15 cents.
Exactly. And when they dump those shares, the open market price drops.
Which triggers the spiral.
Yes. So the next time they decide to convert a chunk of their debt, they get an even lower price.
Which means they get even more shares.
Right. And they dump those, driving the price down further. It becomes a self-fulfilling cycle of downward pressure.
It's like printing new money to pay off your credit card. Every time you print a dollar, all your existing dollars lose 15% of their value.
That's a great way to put it.
Eventually, you have to print a wheelbarrow full of cash just to buy a loaf of bread.
Precisely.
So this $100 million facility is a lifeline, sure, but it is not a lump sum of cash sitting in a bank account.
No, not at all.
It's a facility they draw down by issuing new shares.
Yes.
And if they draw on it heavily while the stock price is low, the sheer volume of new shares will just crush the existing stock price.
They are acutely aware of this gravity.
They have to be.
The only way to survive that kind of dilution is to grow cash flow significantly faster than you are printing shares.
Which leads us directly into how they actually plan to deploy this new capital.
Right.
Because they are executing a radical operational pivot to try and outrun this debt threat.
Yes. What they're calling the dual engine approach.
This is the most fascinating piece of the puzzle to me.
It's very ambitious.
Engine number one is artificial intelligence. And they aren't just, writing blog posts with ChatGPT.
No, this goes way deeper than that.
They are deploying advanced agentic AI, specifically Anthropic's Claude Code and OpenAI's Codex, to literally replace payroll.
Yes.
We are talking about the potential obsolescence of heavy human capital in B2B service agencies.
And the specific examples they reported are highly compelling.
Like what?
Well, their chief operating officer used AI to build a custom ad spend intelligence dashboard.
Okay.
That single internal tool entirely replaced a $5,000 a month external agency cost.
Oh, wow, just wiped it out.
Yep. Another subsidiary needed a custom membership platform. Using AI agents, they built the entire thing in a single weekend.
That is wild. And Eastern Standard, that $2 million web agency they bought, is now using AI for the vast majority of this core development work.
Exactly.
They even absorbed the workload of a departing employee without having to hire a replacement.
Right. The cost savings are immediate.
This is an arbitrage on human inefficiency.
It is.
If you can buy a bloated business at a 3.3x multiple, fire the expensive external agencies, and automate the development work, that 3.3x multiple effectively drops even lower.
Because the cash flow spikes overnight.
Exactly.
And that operational efficiency fuels the second engine of their pivot.
Right, the digital asset treasury.
Under the new equity facility, Onfolio Holdings, ONFO, is taking 25% of the proceeds and putting them directly into cryptocurrency.
That is a bold move.
Very bold.
Yeah.
They currently hold about $2.3 million in Bitcoin, Ethereum, and Solana.
And they aren't just holding it, right?
No, they are actively staking it, generating a 4% annualized yield.
Okay, let's challenge this.
Let's do it.
Why mix boring, steady B2B service agencies with wildly volatile cryptocurrency. What is the strategic logic there?
It is a classic barbell strategy applied to a public holding company.
Explain that for us.
On one end of the barbell, you have the operational digital businesses. They provide predictable diversification and steady cash flow.
But they will never offer explosive 10x growth.
Exactly. On the other end of the barbell, digital assets provide massive asymmetric upside.
But they are incredibly risky.
Precisely. So they use the boring, steady cash flow from the agencies to fund the accumulation of Bitcoin as a Treasury hedge against inflation.
Ah, I see.
It gives retail investors exposure to massive potential upside without the catastrophic risk of investing in a pure-play crypto mining company that has no other revenue streams to fall back on.
Okay, that makes sense. That is the vision. They want to build a modern, inflation-resistant holding company.
That's the pitch anyway.
And to be fair, the CEO, Dominic Wells, is putting his money where his mouth is.
He is.
He recently purchased over 74,000 shares on the open market. Insider buying is generally a strong signal of confidence.
It is, but we really need to look at the institutional side here.
Good point.
While the CEO is buying, institutional backing remains virtually non-existent.
Wait, really? Nobody big is touching this.
Barely anyone. We saw a few funds add tiny positions. UBS added roughly $24,000 worth of shares.
For a global bank, $24,000 is the coins lost in the couch cushions.
Exactly. It forces us to ask a very tough question.
Which is?
Is this dual-engine strategy genuinely innovative, or is it a calculated attempt to use trendy buzzwords like AI and crypto to attract retail trading volume to a microcap that is struggling to escape a debt default?
Oof. That is the ultimate test, isn't it?
It is. It's a race between the compounding yields of their AI efficiencies and crypto assets versus the crushing mechanics of their convertible debt.
If they pull it off, it is a masterclass in capital allocation and technological integration.
Unquestionably.
But if they fail, retail investors will bear the absolute brunt of that VWAP dilution.
They will be the ones left holding the bag.
The tension at the heart of Onfolio Holdings, ONFO, is undeniably gripping.
It's one of the most fascinating setups in the market right now.
They possess this proven, cash-generating acquisition model, supercharged by autonomous AI that strips out human labor costs.
Right.
Yet they are walking a razor-thin tightrope above severe dilution risks and convertible note defaults.
It's a high-wire act for sure.
That leaves you with a deeply provocative thought to chew on.
Indeed. The broader implications for the market are massive.
Because if Onfolio Holdings, ONFO, successfully navigates this debt and proves that an AI-automated crypto-backed holding company actually works at scale,
It changes everything.
could this pioneer an entirely new category of public companies?
It just might.
Could we see a wave of microcaps adopting this exact barbell blueprint as a hedge against inflation and traditional banking?
I could easily see that happening.
Or will the inescapable gravity of that convertible death spiral drag this nanocap down to zero before the vision is ever fully realized?
Watching how they deploy the first drawdowns from that $100 million facility will be the immediate tell.
For sure.
The mechanics of the market will ultimately separate the narrative from the reality.
All right, listeners, what's your take on the future of Onfolio Holdings, ONFO? Are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on the Byte-Size Brief.